Okay, let's get rolling. We're 2 minutes past. I'd like to welcome everybody. Max Winthrop here, CEO of Winthrop Wealth, and today I'm grateful to be your moderator. I would like to welcome you to Markets in Motion, which is what we decided to call this webinar. We're excited to introduce this new open-ended discussion format to our clients and our audience that's tuned in today. And this series is really intended to be complementary to our current content. We put out a lot of current content. There's a lot of writing and research behind the scenes to put out our monthly market updates. So we put out 3 pieces: monthly market updates, client questions of the month, where we answer questions that our clients bring to us, and quarterly videos. We believe that thought leadership is truly the way of the future in this industry, and it's the best way to demystify the wealth management experience by elucidating the thought process, which really for us is, as a wealth management firm, making it easier to understand the way that we think, making it easier for you to understand the way we think and connect with us. And secondly, by educating about financial concepts to better arm you to face your financial futures. And I believe personally, this is a new era for wealth management where transparency will rule. So that's something that we're focused on. And finally, the goal of this new format is to address current market moving themes in real time. So there's a lot going on in the world right now. There has been a lot going on for a long time, but this is dynamic. And so this is a slightly more informal way to address current events. And for our inaugural discussion today, we're going to focus on 3 major drivers of the recent market volatility: the Russia and Ukraine conflict, Fed policy, and inflation. And if we have time at the end, we're going to cover one of our favorite topics, market timing. And with that, I am going to introduce my esteemed colleague, Andrew Murphy, co-CIO. You've seen him before. If you haven't seen him before, Andrew is amazing. He's the man behind the content. And so, Andrew, welcome. Thanks for joining. You're going to be doing most of the hard work today. But 2022, it's been a bit of a rough start from a market standpoint. What's happening?
So yeah, thanks, Max, and thanks to everybody for joining us today. Nice to see so many people sign up. So we're excited. I think this is going to be a lot of fun. So let's get into it. Yeah, you said it. Tough start to the year for most major asset classes. So we'll start by taking a look at the equity markets, and we'll have a look at major equity indices. So we'll look at United States market cap, small, mid, and large. We'll look at different styles in the United States, growth versus value, and we'll look at the international market. So we start off by large cap stocks in the United States. Probably the most well-known index is the S&P 500, down by about 6% for the year. And I'll caveat this with, this is as of last Friday, so 3/18. Mid and small cap companies down anywhere between 5 and 7. And I also think it's worth pointing out, and this kind of jumps off the page, just the divergence that we've had this year between growth and value stocks. So growth stocks, that would be mainly your technology, communication services, consumer discretionary stocks, down about 11%. And the top names that make up the Russell 1000 Growth Index are companies we're all familiar with. It's your Facebooks, your Apples, your Amazons, your Googles, your Netflix, Microsoft, Tesla, many of these kind of mega cap companies. And a lot of these companies had very high valuations coming into the year. So as interest rates have gone up, they've gotten hit. And some of the smaller kind of growth companies have gotten hit even harder, but the index itself down about 11. So there's a big
Andrew, it seems like there's a little bit of a rebalancing going on here. You know, as you said, these big high-flying technology companies were leading growth and returns for clients for the last few years, but now they've sold off a little bit more.
And we've seen a shift. Exactly. We've seen a shift. So value companies to start the year have done very well. So value companies would be like your energy companies, which have done well as the price of oil has skyrocketed, and financials or banks, which have done well as interest rates have come up. So big split between the two. And then international markets, just kind of worth pointing out, we have developed international, that's the MSCI EFA, that would be like Europe, UK, and Japan. And then emerging markets, that would be, say, Brazil, India, China, South Korea, Taiwan. Now, also worth pointing out that Russia was included in most emerging markets indices, but MSCI and other index providers removed Russia within the last few weeks. So no longer will they be in the emerging markets index, but the international markets down between kind of 7 to almost 9%. So again, tough start to the year.
Yes, and quite starkly different than 2021, right? A year where there was almost no volatility. And I know we did a lot of writing about this, tempering expectations as we were coming off really strong returns. And actually in our 2021 client letter, we wrote about how when volatility does rear its head, it's going to hit hard. So let's talk about that for a second.
Yeah, huge difference compared to last year. So most major equity asset classes, equity indices put up double-digit returns last year. S&P 500 up 28.7%, almost 30%. The only major index that was down last year was emerging markets. But for the S&P, up almost 29%. And to your point, Max, very little volatility along the way. So the largest drawdown we saw last year for the S&P 500 was only about 5%. So that's it. Market was pretty much straight up the whole time. Historically, if we were to look back almost the last 90 plus years to 1928, kind of the start of the S&P 500, historically you get a drawdown of about 15% every year on average. Last year was only 5. So we were writing about when volatility does finally hit, it is going to seem a lot different. It is going to seem a lot unique just because we haven't seen it in a while. And then if we pull back even a little bit further, I think it's worth pointing out just how strong recent market performance has been. So on a 1-year basis, S&P up still about 14%, 3-year number on an annualized return up over 18, 5 and 10-year up close to 15, and that compares very favorably to the long-term average for the market, again going back to 1928. Of about 9.7% per year. So the last decade has been exceptionally strong, and especially just the last few years. And Max, you and I were talking earlier about investor expectations and maybe how unrealistic some younger investors might have their expectations set.
Yeah, thanks for mentioning that, Andrew. So we do a lot of reading, as you might imagine. Fidelity put out this study, and it actually covered generation X, Y, and Z to map their expectations, return expectations, if you will, so the performance out of their respective portfolios. And it was a pretty mind-blowing number. So I'm reading from my other screen here. The median annual rate of return expected from the assets managed by Gen X, Y, and Z was 35% in 2021.
35.
And that compares to the boomers, which the survey registered at 9%. So huge expectations, huge return expectations.
That's pretty amazing. And I put together some stats just to kind of put that number in context, because the first time I heard it, I laughed. And, market performance has been strong. There have been some kind of 12-month periods where the market was up by 35% or greater, but 35% is a lot. So a few things to think about. One is I'm sure everybody on this call, including myself, wishes that they could go back to the 90s and buy shares of Amazon. I know I certainly do. But had you bought Amazon on March 1st of 1999 and held through now, the total annualized return would be about 18%. So less than half of what younger investors are expecting. Warren Buffett, the most famous investor of all time, one of the richest people in the world, his track record goes back to 1965. Historically, he's done an annualized return of about 20%. So a little bit more than half of what younger investors are expecting. Peter Lynch, I'm sure some people on the call are familiar with Peter Lynch. Maybe we have some people who invested in his mutual fund when he was running the Fidelity Magellan Fund from 1977 to 1990. But he put together one of the greatest performance periods in in investing history. His track record was 27% annualized return.
We should go talk to him upstairs, Andrew. He has an office upstairs.
I haven't seen him in a while, but would love to. But I mean, what a run! But 27% per year, still quite a bit less than what younger investors are expecting. And last, 35% per year. If you could do that, if you could compound returns at 35% per year, you would turn a $10,000 investment into over $1 billion in under 40 years. So you go from 10,000 to $1 billion in under 40 years if you're able to compound returns at 35%. So as I kind of think about it, Max, either a couple things are going to happen. One, we're going to have a lot of billionaires around in a few decades who are going to make Jeff Bezos and Warren Buffett and Peter Lynch look like amateur hacks. Or we're going to have a lot of people who need to lower their expectations.
Yeah, no,
I'll take the latter.
I'll take the latter too, and thanks for sharing that, Andrew. The data does speak volumes, and while they're historical numbers over time, they've kind of held up, and to look even at Berkshire or Warren Buffett's performance over the 55 years that he's been running portfolio money, being greater than the Amazon return, like that just kind of jumped out to me. But those double-digit returns are absolutely phenomenal, but we do have to align our expectations. That's huge. We can't be so short-term focused. Another piece of that Fidelity study was how short-term focused Gen X, Y, and Z was. So why don't we move into the next segment here, Andrew? I think we've talked about equities. We've focused on equities so far, but how about bonds? How have bonds fared? We know equities were off to a rough start, so how have bonds done to start the year?
So unfortunately, it's been kind of a similar story in the bond market to start the year. So again, these are returns as of last Friday, 3/18. The bond market is down. The investment grade bond market in the United States, that's the aggregate bond index, down a little bit over 5%. Other bond asset classes, corporate bonds down a little bit over 7%, high yield bonds down a little bit over 5%, and muni market down about 5%. So it's been a tough year, and the reason for that, as I'm sure a lot of people are aware, that bond prices move inversely to interest rates, and this year interest rates have gone up quite a bit. So the 10-year Treasury to start the year was at about 1.5%. Currently, about 2.15%. So the 10-year Treasury in just kind of an 11-week period has moved up by about 2/3 of 1%. That's a major move in a short amount of time. So as interest rates have gone up, bond prices have gone down, and you've seen that reflected in bond returns. And I do want to point out, and I think it's important to note, why do we hold bonds? We hold bonds in portfolios to provide ballast, stability, and income. And ballast meaning we want to hold bonds to offset some of the equity risk in the portfolio. So ideally, when you get in these volatile periods, when the equity markets are selling off, ideally the bond side of the portfolio is flat to maybe even going up and going positive. That's what we'd like to see. That hasn't happened to start the year, again, as interest rates have gone up. But again, we're only talking about really an 11-week period. That sort of negative correlation between stocks and bonds will likely come back into play at some point.
Yeah, Andrew, the slide you have up here is pretty remarkable, just to look at the difference of 64 basis points. So if you look at that, that increase in this short period of time, you're coming off such a low base that maybe that's part of the reason why you've seen the impact that you've seen. Bonds haven't acted as the ballast that you just identified. So why have they not acted as a ballast?
That's the key. It's that increase in rates in again a very short amount of time. So as rates have gone up, bond prices have gone down. That's the bad news, Max. The good news on a go forward basis, on a look ahead basis, is that now the yield to maturity of bonds or the bond market is starting to look a little bit more attractive. So this chart shows the yield to maturity of the investment grade bond market, again, the Barclays Aggregate Bond Index. And as you might be aware, the three biggest determinants of return for a bond are going to be the coupon rate, the price at which you buy the bond at, and the time to maturity. And the yield to maturity kind of takes into account all of those factors. So easy way to think about it is the estimated rate of return that you could expect if you purchased the bond today, and assuming that the bond made all of its coupon payments, all of its interest payments, and then paid back principal at the end, so assuming no defaults. And what we'll point out on this chart, and this goes back kind of post-pandemic, is just how much yields have gone up recently. So yield to maturity on the broader bond index kind of bottomed around 1% in August of 2020. And now we're sitting, after moving higher slowly this year, right at about 2.7%. That's not exactly the double-digit returns we saw in the early 80s, but 2.7% is quite a bit higher than what we've seen the last few years. And really, this kind of yield to maturity principle, yield to maturity going up, this holds if you're talking about an individual bond, a bond index, or a bond fund. But any way you look at it, sort of the possible or expected future returns in the bond market are getting more attractive, and that's a good thing. That's the good news.
As you said, the future returns look better than they did not so long ago, and
Certainly.
And this is a really good thing actually for savers and retirees and folks pulling income from their portfolios. They're getting better yields out of their bonds. We're starting to see rates on cash go up as well, and so that's a key piece of the puzzle as well.
Absolutely.
So I think it's time for us to move into our segment on Russia and Ukraine, and it's a real tragedy what's happening over there and turning into a humanitarian crisis. But I will say our job is really to remove the emotion from investing and try to put things into context. So Andrew, let's talk about the conflict happening in Russia and Ukraine quickly. Touch on it. Want to hear your thoughts, and maybe you could give us some ideas of how to put this into context, not from a personal, emotional, political standpoint, but instead on how does it relate to markets and potential returns.
Yeah, absolutely. And I think well said, Max. And it can seem maybe a little bit cold, a little bit callous to talk about stock market performance in the face of a geopolitical event or a war or periods where there are loss of life. But it is our job to kind of put things in a market perspective. So that's what we've tried to do here. We looked at 14 major geopolitical events going back to World War II, and then the market reaction, whether that be 1 week after the event, 6 months later, 12 months later. And I think the key point here, and we'll talk about this a lot more sort of in this presentation, is just that the market does tend to go up over time. It does tend to recover from tough events or tough periods if given enough time. So what this chart says is that 1 week after the event, on average, the market was down about 3.6%. But 6 months later, 12 months later, on average, the market had recovered and performance was generally pretty strong. So 6 months later, up by 6%, 12 months later, up by 7%. So again, point of this chart is to show that the stock market has historically recovered if given enough time.
Thanks, Andrew. So we had about 14 or so geopolitical events here. They all look different. We don't know exactly what the Russia-Ukraine conflict will develop into, progress into, if it's going to be sort of stopped by a ceasefire. There's so many different potential outcomes, so it would be premature to try to make a prediction. But I think you illustrated nicely that we have a range here of various events that have happened over time, going way back to World War II. But it's about time and the time that it takes to recover.
Yeah, and I'll just point out, Max, I think we're now in day 27 of the Russia-Ukrainian war. And over that time period, the market has actually gone up in a decent amount. So it is just, I do think it's helpful to kind of put these events into context, and as always, and as we'll talk about later, just maintain a long-term view when it comes to the market.
Absolutely. So the second piece, we just talked about Russia and Ukraine. The second piece here which has been something that has been largely in focus, is inflation. And so watching inflation is a part of our everyday process. And the difference between being part of our everyday process and where we are today is it's starting to hit, or it has over the last few months started to hit front page news. And that's when we know it's become problematic. So it's starting to really impact consumers' wallets and pocketbooks. We're feeling it. So it's certainly front and center. Andrew, let's take a look maybe at various measures of inflation, because we know it's measured in a variety of ways, where we might be headed, and what are we doing? How are we trying to hedge from a portfolio perspective?
Excellent. So this is the Consumer Price Index inflation measure. It's calculated monthly. It's put out by the Bureau of Labor and Statistics. It looks at food prices, energy prices, apparel, clothing, transportation, vehicle purchases, medical care, housing, and a whole host of other services. So it's fairly comprehensive. We have this chart going back to 1913. So you can see kind of the spike down during the Great Depression. You can see the spike higher during World War II, spike higher during kind of the 70s stagflation era, low inflation for the last several decades, and especially coming out of the financial crisis. And then this move higher we've seen kind of post-pandemic, where inflation is now at 7.9% and at the highest levels we've seen since the early 80s. And then if we look at some other measures of inflation, let's look quickly at the Fed's preferred measure of inflation. This is the Core Personal Consumption Expenditure Index, similar to CPI, but the biggest difference is that this measure excludes food and energy prices. So gas prices going up, not accounted for. Price of groceries going up, not accounted for. So the Fed chooses to exclude that because food and energy prices tend to be a little bit more volatile. But this reading has even core inflation at about 5.2%. Again, the highest levels we've seen since the early 80s. So any way you look at it, any way you choose to measure inflation, it is now far higher than where the Fed would like it to be. And as we'll talk about in a second, now they're getting ready to act to try to bring this down.
So this idea of transitory inflation has kind of been thrown out the window. It's been more persistent than really most economists have expected.
Transitory is officially gone. So the Fed was sticking with transitory for much of last year, and then they pivoted. And as we'll talk about in a second, they are getting ready to act. But what is really caused inflation? And I'd say it's kind of three major things. It's the surge in energy prices. Price of oil is up over 40% for the year, up almost 80% on a one-year basis. We've had supply chain bottlenecks, which has been very frustrating because it's been kind of a series of 2 steps forward, 1 step back coming out of the pandemic. During the pandemic, we had a lot of cities, even countries, factories, businesses shut down. Businesses had trouble finding workers. We had log jams, severe log jams at the ports of Los Angeles and Long Beach that we wrote about. And then we'd see some evidence that these things were starting to clear and get a little bit better. And then you'd hear of more shutdowns. China, for example, just shut down a major city last week. It's since been reopened, but that's going to cause more supply chain issues. Russia and Ukraine, of course, is not helping with the supply chain issues. So series of kind of 2 steps forward, 1 step back. And consumer demand is obviously a huge one. We've had massive amounts of fiscal and monetary stimulus coming out of the pandemic. So consumers have a lot of money to spend, and the labor market is very tight. Unemployment rates at about 3.8%. There are currently a record number, close to a record number of job openings in the United States, close to 11 million. There's something like almost 2 job openings for every 1 person looking for a job. So what happens when businesses have a job opening, they can't fill it? They raise wages. So wages are starting to go up. So average hourly earnings, kind of latest figure, is over 5%. Highest level we've seen in many years. So the consumer for now has a lot of money to spend, and inflation can kind of simply be defined as more money chasing too few goods. And that's exactly what we have right now.
So really across the board, we're seeing inflation in every aspect of our lives.
Absolutely. And then Max, I think it's important to talk about where might we be headed. So this shows the FOMC's summary of economic projections. The Fed releases these economic projections once per quarter, and it is the median projection of the 16 FOMC members. So they anonymously put out kind of their projections across real GDP, across the unemployment rate, for inflation, and for the federal funds rate. So it's not meant to be kind of a roadmap or the committee consensus view. You'll probably hear me reference about, the Fed thinks or the Fed is projecting in relation to the summary of economic projections, but that's really just for kind of simplicity purposes. But for this year, the Fed has inflation ending the year at 4.1%. Now that would be down slightly from the 4.9% we ended last year at, but it's still far above the Fed's target of about 2%. And the other thing I'll point out is that even 2023 at 2.6, 2024 at 2.3, that's still above the Fed's target of 2%, even by the end of 2024. And also, I think it's worth noting, Max, do you remember the Fed's forecast for 2022 going back a few months was quite a bit lower than where we're at now?
I want to say, you probably have the number, but I want to say it's doubled or close to doubled.
You're exactly right. So December of 2020, 15 months ago, the projection showed inflation ending 2022 at 1.9%. So just in the last 15 months, their forecast for inflation has doubled, which is pretty staggering to see.
It is staggering. And the other thing that we talk about internally a lot, Andrew, is, predict and predict often if you're going to predict. So, it's just something to keep in mind. And the Fed has the same data that we do, and they're making the best decisions that they can. But inflation is real, and it's here, and it's running hot.
Is it Yogi Berra? It's tough to make predictions, especially if you're talking about the future.
Anyway. I think you're right. So how about hedging for this? What can you do from a portfolio standpoint?
Okay, I think we can do kind of three main things. And this is what we've been doing for over a year now, and I think this has worked out fairly well for us. So first is keeping low levels of cash in portfolios. We know that purchasing power is severely eroded by inflation. So if you're holding just pure cash in a checking account while inflation is high, the purchasing power of that cash is getting pretty much hammered every month now. So I think what we do well from a financial planning and from a portfolio perspective is identifying and accounting for cash flows and upcoming cash flow needs in portfolios. So as part of the financial planning process, we'll identify those cash flows, and as part of the investment process, we'll invest at least 2 to 3 years of upcoming cash flow needs in ultra short-term fixed income. So at least we're earning a little bit of income, which can cut into inflation. So we're not just holding kind of cash in a checking account where it's not earning anything. Next is we've avoided to this point long-term bonds. So long-term bonds are the most interest rate sensitive. They get hit the hardest as long-term interest rates go up. So to this point, we've avoided holding those. But as we talked about earlier, yields on bonds and long-term bonds are starting to get more attractive. So this might be an area where we start to dip our toe into a little bit from a portfolio perspective in the upcoming months. And then last, and this is important, we have tilted toward what we call quality companies. So companies that can grow their cash flows, can grow their earnings, can grow their dividends if they happen to pay one in these kind of tough inflationary type environments, and ideally companies that have pricing power that can pass on some of those costs. So always looking for strong balance sheets, strong cash flows when it comes to the equity side of the portfolio.
So this concept of cash is really interesting, right? One of the primary reasons why people invest or should invest is to prevent the erosion of their purchasing power. So at current levels of inflation, the price of everything essentially is doubling every 10 years, 10, 12 years or so. Mm-hmm. And that's a scary proposition, right? So if you were sitting on cash and the price of everything doubled, you run out a lot faster. And so again, one of the primary reasons why we invest and why we take any level of risk is to be able to beat that purchasing power, to preserve that purchasing power. So with that, Andrew, thanks. I think those were great. So 3 sort of strategies for hedging there. Let's move on to our third market driver, Fed policy. It's been front and center. We've been writing about the outsized influence of the Fed on the markets for a long time now, for stocks, for bonds, and even for alternative investments.
So Max, as you know, we spend a lot of time talking about the Fed, and really I think that's for good reason. So what is the Fed? The Federal Reserve serves as the central bank of the United States, and they are in charge of setting monetary policy for the country. Fed is supposed to be an independent organization. They have their mandate from Congress to promote maximum employment and price stability. So they want to keep unemployment low, and they want to keep inflation low at the same time. And they do that, and they conduct monetary policy primarily through adjusting interest rates and the money supply and controlling overall financial conditions. So I love this quote from the Fed. This comes right from their website. It says, monetary policy directly affects interest rates. It indirectly affects stock prices, wealth, and currency exchange rates. Through these channels, monetary policy influences spending, investment, production, employment, and inflation in the United States. And Max, that is a lot.
It is a lot. It's a lot to take in, and it's a very complex system, how this all works. But Andrew, I think what we're going to get to in a little bit is everything's related and everything's tied together in some way, shape, or form, and the Fed is obviously a big piece of that.
Yeah, and we at Winthrop Wealth, we make our asset allocation decisions based on economic growth, central bank policy, fundamentals, and valuation. So really paying attention to what the Fed is doing and what they might do in the future is critically important because it really influences many other asset classes, or really influences all asset classes. So let's take a look at kind of current Fed policy. This first chart shows the federal funds rate. This is the Fed's primary tool for conducting monetary policy. It is the interest rate for overnight borrowing between banks. And the Fed funds rate is important because it influences many other rates, from savings accounts, CDs, treasury bills, mortgages, auto loans, credit card loans, student loans, many other types of bonds. Probably the easiest way to think about it is it's kind of the starting rate for which many other rates are based off of. So this chart shows the federal funds rate kind of coming out of the pandemic. Just a few quick things I'll highlight. One is that the Fed aggressively cut rates effectively to zero during the early part of the pandemic, during March of 2020. They've kept the rate there up until very recently. And just last week, we had one 25 basis point rate hike, bringing the top end of the federal funds rate to 0.5%, or about 50 basis points. So the Fed has raised rates for the first time last week, first time since 2018. And then where might we be headed? Because I think this is probably a more important question. We'll go back to the summary of economic projections. This is probably the best way to think about it. Right now, the Fed is projecting 7 rate hikes in total for 2022. So we've already had one. So the Fed is projecting 6 more this year. So 7 total this year and 4 more by the end of next year. That would bring the federal funds rate top end of the range to about 2.8%. And right now the Fed is thinking it'll probably stay that way into 2024. But again, this
has changed a lot, hasn't it?
Absolutely. This, like the inflation forecast, has changed quite a bit. So in December of 2020, again, 15 months ago, not that long ago, the Fed was thinking 0 rate hikes in 2022. So 15 months ago, they were at 0. Now they're at 7. And what we'll talk about it in a second is the reason for that is now the Fed is finally admitting that inflation is not transitory, that inflation has become a problem. And in response to that, they're going to have to raise rates and tighten monetary policy to bring inflation down. So kind of bottom line, Fed in summation, monetary policy is tightening. The Fed is working to bring inflation under control. They're raising interest rates, and they will also announce a plan probably in May to start shrinking their balance sheet. And the other thing, and I think it's important to point this out, the Fed thinks, okay, we're gonna tighten monetary policy, we're gonna bring inflation under control, but they still think that the economy is very strong, and they still think that a recession over the next year is unlikely. So this is a quote from Fed Chair Jerome Powell. He said this just last week, and right now he's thinking all signs are that this is a strong economy and one that will be able to flourish in the face of less accommodative monetary policy. So the Fed still thinks the economy is strong, driven by strong consumer, a strong labor market, and consumer balance sheets that are in very good shape. So as long as demand is strong and the consumer has money to spend, the Fed is thinking that the economy should be able to withstand, and not only withstand, but flourish in the face of tightening monetary policy. That might be a little bit optimistic, kind of from our point of view, but again, this is just a snapshot in time. A lot can and will change over the next 12 to 18 months, and we've seen, and as we've shown, just how different things are compared to what the Fed was thinking 12 months ago.
And Andrew, I'll just add, I like how you highlighted flourish, because there are algorithms out there that analyze the text from all the Fed meetings to determine, trading, algorithmic trading. And so is it being hawkish or dovish? Are they being accommodative, or are they tightening? But flourish is a pretty powerful word. And the data that we see too is, at least the US economy is on solid footing. One thing that I was curious about is there any data on how the stock market performs during a Fed tightening cycle?
There absolutely is, and we looked at this in our February client question of the month. So this goes back the last 12 Fed tightening cycles. So starting in 1954, market was higher in 11 out of the last 12 tightening cycles for an average of 9.4%. So each time period is a little bit different, but I think the main point is really that just because the Fed is tightening doesn't mean the market has to sell off. The market still can increase when the Fed is tightening. But as we'll talk about in a bit, kind of our view has been that it likely means that volatility will increase as well. So the market can still go up. It's likely that it's just going to be a bumpier ride.
Similar to what we've been talking about for a while from a increased volatility standpoint. Thanks for sharing that. That's a really nice chart. I like that a lot. And hopefully it holds, right? No one has a crystal ball, but
right.
Hopefully it holds. So just to Andrew, to review what we've hit, we've talked about the Russia-Ukraine conflict. We've talked a little bit about inflation, and we've talked about the Fed going from being accommodative, to tightening, a little bit more restrictive. And so all these things work together. I think it'd be good maybe to take a minute to talk about, how these are looped together. I know you and I internally talk about this negative feedback loop that is occurring right now.
Yeah, it's a tough period because you've got the Russia-Ukraine war going on. That's creating a lot of uncertainty. It's creating a lot of volatility. It's putting tremendous upward pressure on commodity prices and oil prices. That's driving inflation expectations higher, and again, creating a lot of market volatility. So typically in a time like this, the Fed would not be thinking about raising rates, might even be thinking about cutting rates, or probably at the very least, just keeping things kind of status quo. But in this environment, because inflation has now become a problem, the Fed has to act to raise rates. And then just the fear, the thought that, okay, the Fed is going to raise rates, the Fed is going to tighten, maybe they're going to tighten too much, that's creating more and more volatility. So it's kind of feeding off itself in a little bit, or off itself a little bit. So, of course, we don't know exactly when this is going to end. I mean, obviously in the short term, a ceasefire between Russia and the Ukraine would help sentiment a ton. But the situation is very fluid. And I'll point out again that, the market's down 6%, kind of the largest drawdown we've seen this year has been about 13. So pretty much the market has gained back almost half of its loss for the year. And it's done so since the start of the Russia-Ukraine war. So we've seen a lot of volatility. Things are probably still bouncing around. And we really do expect that volatility to continue. But nice to see we've recovered a bit so far.
Yeah, we wrote last year about this going into this year being predictably unpredictable, and I think it sort of played out that way, right? And what we do know about the market, or Mr. and Mrs. Market, as some folks call it, is that it doesn't like surprises. So any type of surprise is going to create additional volatility. Positioning, Andrew. I see you have a slide up here. So how should an investor think about positioning in advance of this, during this, et cetera?
Yeah. So what we've been doing is we've been getting more defensive, and now I'd say it's very safe to say we are defensively positioned. And we got that way because last year, as the market was going up in almost a straight line, we were taking profits. So we were trimming equities as the market just kind of kept hitting new highs. It seemed like almost on a daily basis. So getting a little bit more defensive, shifting portfolios, taking profits, I think that was a prudent thing to do. We knew that volatility was going to pick up. We thought the removal of the unprecedented amount of stimulus would cause that volatility. That has. And then, of course, the other shot that, of course, we did not see coming and couldn't plan for over a year ago is Russia and Ukraine. But we expected volatility to pick up, and it certainly has. So on the equity side, we're tilted toward quality stocks in the United States. And on the fixed income side, still that focus on ballast stability and income while trying to keep the interest rate sensitivity low. So the other thing that I'll mention is, some of the best investment opportunities occur during volatile periods. And in these periods, because we know they happen often, we like to say we will do our best to make lemonade out of lemons, make the best of a tough situation. So we can do things like we can tax loss harvest. We can reposition portfolios. For clients that added new money to their accounts, we can selectively put that to work. And we have been doing those things. We have been trying to take advantage of this environment. And really going forward, we expect we'll have more opportunity because, again, we do expect that volatility will be here for a while.
Okay, that's great. So what can we do during these volatile periods? It sounds like, there's opportunity that presents itself every once in a while. You need to be ready to take advantage of that, whether it's tax loss harvesting or adding some exposure. I'll just take a second and quickly say process is so important here. And if you're working with an advisor, you really want to make sure you understand the whole process and what they're doing. So we're writing about this every single month and communicating that to our clients, exactly what's going on and what we're doing. And that should translate into the portfolios. Right? If your investment management or wealth management firm is saying that they are trimming into strength and they're adding exposure and making your portfolio more aggressive, then that doesn't really line up. So one thing that we pride ourselves on is making sure that there is that transparency and there's that connection across the board for everything that we're doing. Are we actually doing what we say we're doing? So that's important. But Andrew, you have some great points up here that I think would be great to share. So maybe some advice on how to navigate volatility?
Absolutely, and I think you said it, and it does really start with the process. It absolutely helps to have a thorough process. And during these periods of market volatility, we follow the same playbook. We convey the same messages. Our clients on the call today, they remember the things we were saying in the two kind of most recent volatile periods, whether that was March of 2020 or December of 2018. We're doing and saying the same things, and we will continue to do that in future periods of volatility because we know future volatility is inevitable. The market does decline quite often, actually. So kind of our three key pieces of advice are first, having the right mindset. So maintaining a long-term viewpoint and avoiding the impulse to market time. So during these periods of volatility, I think controlling your emotions is critical. Market timing decisions are usually emotional rather than kind of data-based. It's usually an emotional of, I think the market has to go down, or I think the market has to crash further. That's usually not a data-based decision. So controlling your emotions, maintaining that long-term viewpoint is critical. And Max, do you want to speak for a second on just the importance of the financial plan and the importance of pairing the financial plan with an investment process?
Absolutely. So I'll touch on that, but Andrew, that avoid the impulse to market time. Hopefully we'll have a few minutes to talk about market timing later, but those knee-jerk reactions are what you end up shooting yourself in the foot. Hopefully, if you're working with another advisor, they've never tried to market time for you. The financial plan is sort of the foundation of our process here at Winthrop Wealth. where we're defining the cash flow needs, we're looking at the balance sheet, assets, liabilities, and so it's really the construct, the lens through which we look at how do we then invest the money. Okay, so once we understand a client holistically, understand their family, their goals, you know, how they're positioned from a financial standpoint, then we can, only then, should I say, can we begin to understand the level of risk that we should be taking with the portfolio assets. There can be a mismatch there if you haven't done the financial planning, and that's really scary, right? Maybe somebody is incredibly leveraged, they go to an advisor, they want to be pedal to the metal risk, and then they have to withdraw during a difficult period, and they lose their principal. So it's all about the process of understanding the client as a whole, the level of risk that they can take, and then allocating them appropriately and making sure we plan for any cash flows that they need from the portfolios. And that's one thing that we do really well is we reserve. Andrew, I know in some of our models, we have our risk models, we have, you know, a couple of years of cash flow reserved. So
Yep.
during periods like this, our clients are less concerned because they know where the money's coming from. That's really important.
Max, I would say I think one of the biggest mistakes an investor can make is not planning for an upcoming cash flow need, having that invested in risk assets. The market declines, and then at a low or after a significant decline, then the investor needs to take the money out of risk assets and maybe sell some securities at low prices because they didn't plan for that cash flow. So that's very value destructive, and really we try to do all we can to guard against that. And the last point I'll mention on the investment process is we have a comprehensive, we have a database investment process. It's based on risk management, asset allocation, and security selection. As we said, we ensure that cash flow needs are met, and then we'll invest the rest of the assets in a globally diversified portfolio. And last, it's that lemonade out of lemons principle, trying to take advantage of opportunities, doing I think prudent, smart things like tax loss harvesting and repositioning. So when all of those things come together, I really think that's the best approach to get through these volatile periods.
That's a great sort of segue into our quick conversation on market timing, and then hopefully we've incorporated some of the questions in what we've been discussing already, Andrew, but if there's some questions at the end, hopefully we can take a couple. So it's time to talk quickly about one of our favorite investment principles that we just alluded to. It's core to our investment philosophy. It guides our daily process, market timing. Why are we so passionate about it? Because it doesn't work. Anybody that tells you that it works or that they can do it, turn and run the other way. Because essentially you'd be able to make unlimited amounts of money. You'd be like an ATM machine, and everybody wants that, right? But it's not realistic. So Andrew, let's jump into market time.
So I'll just point out all these charts are from our July 2021 client question titled "Market Timing Doesn't Work." All these charts are at the end of, as of the end of 2020. We'll probably update these within the next few months, put out a fresh version of this probably in July. But I think important just to kind of note what is market timing and what it isn't. It's not making adjustments or making tweaks to your portfolio, looking for opportunities and making adjustments. It's not that. It's not even adjusting your portfolio as your financial circumstances change. I think that's a very prudent, very smart thing to do. We do that all the time for clients. Your asset allocation for a 20-year-old probably will change as you get to become an 80-year-old with different goals, different objectives, different needs. So adjusting your portfolio based on your financial circumstances is not market timing. What it is thinking that the market is too high or the market has to decline or decline further, selling a large portion of your equity holdings. Keep in mind that if you have a taxable account and you sell a large portion of the equity holdings, you're probably going to generate a substantial amount of capital gains. And you're probably going to be a little bit surprised when you have to pay the taxes on that the following April or whenever you do so. So it's selling a large portion of the portfolio, waiting on the sidelines, waiting for the market to decline or decline further, getting back in at the market low, and then riding that back up to new highs. Seems easy, seems kind of simple, very difficult to do in real time and impossible to do consistently. And I'll just say we've talked about a lot of famous investors who have more of a buy and hold approach, your Warren Buffetts, your Peter Lynch's. there is nobody on record in history that's ever made a substantial fortune using market timing as a strategy. As Max mentioned, if you could market time consistently, you'd essentially be able to make an unlimited amount of money. But there's a reason why, the list of billionaires doesn't include any market timers, because it just doesn't work. So these slides, I think we have some really great charts, really great slides that reinforce our investment philosophy and reinforce the fact that this is a losing strategy. So
Andrew, you need to get two things absolutely right when you market time, right? When to get out and then when to get back in.
That's right. Two things exactly right. And most people get the second one wrong, kind of when to get back in. So let's look at kind of a few key principles here. The first is that the stock market goes up over time. No surprise here. We have a chart of the S&P from 1928 through 2020. Total annualized return in the market over this period is about 9.6%. So had you invested $10,000 into the S&P in 1928, it would have grown to over 48 million by the end of 2020. 10,000 to over 48 million. Again, that's the compounding effect over long periods of time. But as I'm sure you are aware, many challenging time periods over this 90 plus years in the market. You had the Great Depression, you had World War II, you had stagflation in the 70s, you had the crash of 87, you had the tech bubble of the early 2000s, you had the financial crisis of the mid 2000s, you had the pandemic sell-off last year. Over the time period, there were 11 bear markets, 15 recessions, dozens of corrections and pullbacks, but it's maintaining a long-term viewpoint because, again, the stock market does go up over time. And then I think it's a nice kind of transition into, okay, the market goes up over time, but market declines are very common. So here we're looking at the S&P from 1980 through 2020. And what this chart shows, the black bars show the calendar year performance for the S&P 500, and the red dots show the largest intra-year decline. So if we look at 2020, market was up by 18.4% for the year, but we had a decline from February 19th through March 23rd of 2020, where the market dropped 34%. So for the year, January 1st through December 31st, the market was up by 18.4%, but we had almost a decline of a third from February to March. So throughout this entire period, the market was up about 12% per year, and on average, the average decline for these red dots is 14% per year. And actually, if we were to stretch this out back to 1928, the average intra-year decline is about 15%. So again, the market goes up over time, but these declines are actually very common. Never feels great when it happens in real time, but the market does decline quite a bit. And this next chart shows the difficulty in market timing. It demonstrates exactly why market timing is so difficult. So we're showing $10,000 invested in the S&P 500 from 1980 through 2020. Over this 40-year period, the market is open every year about 250 trading days. So over 40 years, we've got over 10,000 trading days in the market. Had someone invested $10,000, stayed fully invested the entire time, that $10,000 would have grown to about $1 million. Had they missed just the 10 best days, so again, 10 out of 10,000, had they missed just the 10 best days, their return would have been less than half, 460,000 versus over $1 million. And to make things kind of more challenging, best days often come during periods of significant volatility. So actually over this time period, 9 of the 10 best days happened either during the financial crisis or during the pandemic sell-off of 2020. So when things get really volatile, it's easy for an investor to get worried, frustrated, kind of throw in the towel, cash out. But what can happen is you'll miss the rebound, and you'll miss the rebound off the bottom, which sometimes is very strong. You might miss a best day, and that's very value destructive to portfolios. So missing best days crushes investor returns.
I love this chart, Andrew. I just think it's telling why we want to stay invested and why we want to have a strategy to stay invested. You know, that's devastating. You lose more than half of the value if you miss 10 days over a 40-year time period.
Absolutely. And this is the proof statement for why market timing doesn't work. This is a study from Dalbar. They looked at returns from 2001 through 2020. So over this period, we had the S&P 500 up about 7.5%. It's a little bit lower on an annualized basis from some of the other periods we've looked at. That's because we're starting kind of during the tech bubble and also going through the financial crisis. So 7.5% over this period. 50-50 portfolio up about 6.5, even the bond market up about 5, but the average investor during a pretty good period only up 2.9%, a little bit better than inflation of 2%. And the reason why, or the reason Dalbar cites, the main reason for the poor investor performance is market timing mistakes.
Market timing mistakes, being really good at making really bad decisions consistently. That's what I call it. And this isn't easy, right? You know, that average investor number, I'm very familiar with the Dalbar study. It also includes advisors. And so that's something to keep in mind is, again, come back to process. What's the process? What's the philosophy? How's the process run? Do they stick to the process? Is it consistent? So important.
Absolutely. And then Max, kind of, you know, someone might be wondering, well, okay, if not market timing, then what should I do? And I think it's important, and we'll come back to this again, just remember the value of time and remember the benefit of having a diversified portfolio. So this is kind of a busy chart, but give me just 1 second to explain. We looked at various portfolio mixes from 1976 through 2020. So all the way here on the left in kind of the dark green is a portfolio of 100% stocks. In the teal, we have 80% stocks, 20% bonds. In yellow, we have 60% stocks, 40% bonds, all the way until we get kind of in the bright green, 100% bonds. And we looked at these various portfolios over various 1-year, 5-year, 10-year, and 20-year rolling periods. And the first thing I'll highlight is if you notice the left side of the page, and let's look at the yellow, the 60-40 portfolio, just the wide range of outcomes that a portfolio can have over a short time period, over a 1-year period. So a 60-40 portfolio, 60% stocks, 40% bonds, has ranged anywhere from -25 to almost +50. That's a wide range, average of 10.5. But as you start to go to the right side of the page, you'll notice the range of outcomes narrows because now you've given the market a chance to recover and you've given your portfolio to have kind of the compounding effect over long periods. So a 60-40 portfolio over 20-year periods, the worst it's ever done is 5.5% on an annualized basis. The worst it's ever done is 5.5% on an annualized basis. Best it's done is 15% for an average of about 10. But again, it's giving, or it's understanding that markets can be incredibly volatile over short time periods. And it's knowing that over the long term, if you have a diversified portfolio and you give your portfolio a chance to compound, your chances of generating a positive return go up dramatically. So what we tell our clients usually is focus on the right side of the page. Remember the benefit of a diversified portfolio and remember the value of time.
Andrew, this is hands down my favorite chart. If there's one chart that we could show clients, our audience, it would be this one for why we invest. This is good to understand, this chart, because it is the reason why we invest. And at Winthrop Wealth, we typically will not put dollars into risk assets unless there is over a 3-year time horizon. But this is essentially showing you that with time, depending on the portfolio allocation, like a 60-40, Andrew, 10-year rolling, right? Look at the 10-year rolling.
10-year over 10-year
never lost money.
Never lost money.
You've never lost money. And so that's part of why we invest. I know we're at the hour. So what we'd like to do, thank you for joining everybody today. We'll stay on if we'll take 2 or 3 questions. Happy to stay on. This most likely we will repost on the website. We'll also follow up with everybody to circulate links for our commentaries and our writings. And we're going to have another topic. It's going to be a little bit different, but we're excited to do this again. So thanks again for joining. We're going to stay on for 3 to 5 minutes to do a few questions if you'd like to hang on. Lucas, any questions?
Yeah, we have, how does Winthrop Wealth make investment decisions during periods of high volatility?
That's a great question. And I'll let Andrew answer, but I'll just open by saying there's always, Andrew, maybe if you pull up that chart, there's always volatility. It's just a question of the time period that you're looking at. So there may be a time period where there's a lot less volatility, and there may be a time period where there's a lot more volatility. But we're always making investment decisions based on the financial plan that we construct for the client. So are you able, we look at risk in two ways. One is when we build out your plan, we almost do it like a business. So you have a balance sheet and then you have a profit and loss statement. And from that, we assess how much risk, without understanding your personal preferences, how much risk financially are you able to take based on what you have and what's coming in and what you're spending. And then we go a level deeper and say, personally, how comfortable are you, even if you can take the risk, how personally comfortable are you with taking that risk? And we'll adjust. That's our adjustment factor. So typically, what we do with new money during more volatile times is we either extend or accelerate the investment horizon. So Andrew, I'll let you comment on that too.
Yeah, and I think kind of the two key things are being able to tax loss harvest and reposition. So if we're talking about a taxable account, a lot of times what you'll see is your portfolio might have some unrealized losses. What we can do dynamically, kind of aggressively, proactively, is sell out some positions with losses, buy similar but not identical positions, never get out of the market, even for a second, but able to capture the loss on the sold security so that we can use that loss to offset future gains. So tax loss harvesting is one thing that we'll do during volatile markets. And the other is repositioning and just looking for opportunities. So as we've said a lot on this call, some of the best investment opportunities occur during periods of significant volatility. If you were to look at kind of market returns over the last several years, or look at a chart of the S&P 500 over the last several years, some great times to buy were during the most volatile periods, December of 2018, March of 2020. The market's up quite a bit since then. So when we think about repositioning, it's kind of both across and among asset classes. And across meaning there could be some dislocations, say between large, mid, small caps, between US and international markets, between different sectors, between different industries, between types of investments. So we'll go through our process, we'll go through our asset allocation process, we'll look at fundamentals valuation in the context of economic growth and central bank policy, and we'll make adjustments. We'll look for those areas that have dislocated, and we'll look for those areas that now have more value. And we'll rotate a little bit into those. The other thing we can do is rebalance to bring asset allocation back up toward target levels. So just as an example, let's say you started the year at 60% equities and 40% fixed income. Then the market declines 20%. Now your portfolio might be closer to 50% in equity. What we can do is use that as an opportunity to buy in at these new low prices, bring the asset allocation back towards 60, bring the equity allocation back towards 60, and reposition that way. So it's always being dynamic and proactive to be able to take advantage of these opportunities as they come up, because sometimes you know, the thing we're upset about in volatile markets is that it happens so quickly. You might not be able to do everything you wish you could have done. So it's important to be able to be quick, and it's important to be able to react quick, because markets can change, markets can adjust very, very fast.
Thanks, Andrew. We have a couple more here. I'm going to pick one more in the interest of time, and then what we'll do is we'll follow up with an email, and always free to reach out to us on our website, winthropwealth.com. We have emails and phone numbers to reach us. So let's go with Lucas is sending me some questions right now.
Actually, I think there's a great question around just the tax consequences when you're trading in a taxable portfolio and taking those into consideration based on the volatility and any adjustments that you're making. I think that's just a great note, and I know we talk a lot about that with our clients. And Andrew, I know that's something that you are pretty adamant about.
So what's the question, Lucas?
How are you taking taxes into account when you're looking at making adjustments to the portfolio?
So Andrew has I'm sure Andrew has a wealth of things he could talk about on this topic. But one thing is, first and foremost, you never want the tax tail to wag the dog, right? And so some people get so obsessed with taxes and will make decisions purely on trying to save on taxes, and that's not always the best course of action, right? And so we have to look at things in a broader context. But the second piece is, you're absolutely right, is taxes and investing go hand in hand, and we need to make sure as a firm for our clients that we're maximizing the opportunities to save on taxes, whether that's through financial planning or making prudent decisions on the portfolio front. And Andrew can actually walk you through a recent scenario where we've had this downdraft in the market, and there was an opportunity for us to tax loss harvest and call it the muni bond space in our muni sleeve for taxable accounts, which doesn't always present itself. So Andrew, I think that might be a good scenario to just quickly talk about.
Yeah, and we've talked about sort of the impact that increasing interest rates have on bond portfolios, either bond funds or individual bonds. So we do own some municipal bond funds. As interest rates have gone up, we've seen the prices of some of those go down. We're generally pleased with how the performance of those funds has been on a relative basis, but as interest rates have gone up, we've seen some losses. So what have we done? We've tried to be proactive. We've gone out, we've searched for those positions with significant losses, and we've rotated into different funds. So keeping the same investment exposure, keeping the municipal bond exposure, but using a new fund, selling the original fund, so we're able to capture that loss. And again, we can then use those losses in the future to offset future gains, which is very important. So we're always on the lookout for those things. As Max mentioned, we do not let the tax tail wag the investment dog. On the other hand, and I think this is key, it's key to find a balance with these things. So we do pay attention to taxes. As part of our financial planning process, we're doing a lot of tax strategies, a lot of tax minimization strategies, and doing a lot of projections. So we are very clear with the amount of gains that we may generate in portfolios. When we construct portfolios, we're trying to do so to get our target investment exposures in the most tax efficient way possible. So constructing portfolios from that way, when we're adjusting, repositioning portfolios, there's a lot we can do and a lot of strategies we can implement by being very precise in the trades that we make to try to minimize the tax impact. So we're always on the lookout for that.
Thanks, Andrew. Thanks for that context. So that's 10 minutes. We were able to answer a few questions. Happy to do so. We're going to wrap. Thank you for those of you who stayed on. If you have further questions, please feel free to reach out to us. Again, really nice to have you join us for our session today. And we will circulate information on future sessions. They may look a little bit different. If there's a big market event or something that's happening or new drivers that emerge, we'll probably put something together for that. But markets in motion, successful first webinar. Andrew, thank you. Thank you for today. Really appreciate it. Grateful for everybody who joined.
Thanks, Max. Thought that was an excellent discussion. So yeah, look forward to more in the future. Thanks, everyone.
Take care.